The world feels like it's falling apart. Every day, the headlines seem worse than the day before. Wars are spreading across the Middle East. Missiles dominate the news. The conflict between Israel and Iran has pushed the region into one of its most dangerous moments in years. At the center of it all lies one narrow stretch of water that almost nobody talked about until recently, the Strait of Hormuz. If that single waterway were ever blocked, the impact wouldn't stay in the Middle East. It could affect fuel prices, food costs, shipping, inflation, and nearly every economy on Earth. Experts warn about an oil shock. Governments prepare for uncertainty. Families worry about the rising cost of living. So here's the question. If the world is becoming more dangerous, why are stock markets still sitting near record highs? Shouldn't investors be running for the exits? Shouldn't billions of pounds and dollars be disappearing from the market? Instead, some of the biggest companies in the world continue to gain value. To many people, it doesn't make sense. Is Wall Street ignoring reality? Are investors making a huge mistake? Or do the world's biggest financial institutions see something that most people don't? The answer is far more surprising than you might think. Because this isn't the first time the world has looked like it was falling apart while the stock market kept climbing. History has seen this strange pattern again and again. And by the end of this video, you'll understand why wars, oil crises, and frightening headlines don't always send markets crashing, and why what looks irrational today may actually follow a pattern that's been repeated for decades. Most people judge the economy by what they experience every day. They notice higher grocery bills, higher fuel prices, higher mortgage payments. They hear about layoffs, bankruptcies, and businesses struggling to survive. And naturally, they assume the stock market should be falling too. It seems like common sense. If life is becoming more expensive and uncertain, then businesses should be worth less. But that's not how financial markets work. One of the biggest mistakes people make is believing that the stock market and the economy are the same thing. They're not. The economy reflects what's happening today. The stock market is constantly trying to predict what will happen tomorrow. That's why markets often behave in ways that seem completely disconnected from reality. Sometimes stocks crash even before a recession officially begins. Other times, they begin recovering while the news is still terrible. It feels backwards. And that's exactly why so many people get confused. Today's headlines are filled with conflict in the Middle East, uncertainty over global trade, rising government debt, and concerns about inflation. Now add the possibility of disruptions around the Strait of Hormuz, one of the world's most important oil routes. On paper, this should be the perfect recipe for panic. Yet investors continue buying shares. Why? Because professional investors aren't simply reacting to today's headlines. They're constantly asking a different question. What does the world look like 6 months from now? What about next year? What about 5 years from today? That difference in thinking explains almost everything you're about to see. Section 1. Why the Strait of Hormuz matters. Before we can understand why markets remain so strong, we first need to understand why the Strait of Hormuz matters so much. At first glance, it doesn't look particularly important. It's simply a narrow waterway between Iran and Oman. But appearances can be deceiving. This small stretch of sea connects the Persian Gulf to the rest of the world. Every day, enormous oil tankers travel through this passage, carrying millions of barrels of crude oil and other energy products to countries across Asia, Europe, and beyond. For many nations, this route is one of the fastest and most important ways to receive energy supplies. That's why every time tensions rise in the region, investors immediately begin watching the Strait of Hormuz. Not because they expect disaster every time, but because even the possibility of disruption can affect global markets. If shipping becomes more difficult, oil prices can rise quickly. Higher oil prices make transporting goods more expensive. Factories pay more for energy. Airlines pay more for fuel. Shipping companies face higher costs. Eventually, businesses may pass those costs on to consumers. That means higher prices in shops, more expensive travel, and renewed pressure on inflation. And inflation is something central banks watch very closely. So a conflict thousands of miles away can eventually affect the price of everyday items almost anywhere in the world. That's why financial markets pay so much attention whenever the Strait of Hormuz appears in the headlines. But here's the strange part. Even with these risks, stock markets have remained remarkably strong. Why aren't investors panicking? The answer begins with one simple fact. Markets don't trade today's reality. They trade tomorrow's expectations. Section 2. Markets don't trade today's news. This is probably the hardest idea for new investors to understand. Most people think the stock market reacts to today's news. In reality, the market spends most of its time trying to predict the future. Imagine driving a car. You don't spend the entire journey looking in the rearview mirror. You keep your eyes on the road ahead. The stock market works in much the same way. Investors already know today's headlines. They've already seen the news about wars. They already know oil prices are moving. They already understand inflation remains a concern. Those events are no longer surprises. Instead, investors ask different questions. Will this conflict become worse? Will it remain contained? How long might it last? Will governments find a diplomatic solution? Will oil supplies continue flowing? Could central banks lower interest rates later this year? Every answer changes expectations. And expectations move markets. That's why you'll sometimes see something that feels completely backwards. Bad news appears on television, and stocks go up. Not because investors enjoy bad news, but because they believe the long-term impact may be smaller than people fear. Markets constantly compare reality with expectations. If investors expected something much worse, then even bad news can become good news. That's why the stock market often seems disconnected from everyday life. It isn't ignoring today's problems. It's trying to estimate tomorrow's opportunities. And throughout history, that simple difference has created some of the biggest misunderstandings in finance. Section 3. Why wars don't always crash markets. It sounds unbelievable, but history tells us something very surprising. Wars create fear. Fear creates uncertainty. And uncertainty usually causes markets to fall. But only at first. If you look back over the last 100 years, you'll notice a pattern. Markets often react sharply when a conflict begins. Investors sell. News channels predict disaster. People rush towards safe investments. Then something unexpected happens. As the situation becomes clearer, markets begin to recover. Why? Because investors stop asking, how bad is today? Instead, they begin asking, what happens next? Take the Gulf War in 1991. When the conflict started, markets became nervous. But once investors believed the war would be relatively short, stocks recovered quickly. The same thing happened during many other geopolitical crises. Even after the invasion of Iraq. Even during periods of rising global tensions. Even after Russia invaded Ukraine. Markets experienced volatility. Some sectors suffered badly. Energy prices jumped. But after the initial shock, investors started focusing on what businesses would earn in the future rather than what had already happened. This doesn't mean wars are good for markets. They're not. Wars destroy lives, infrastructure, and economies. But financial markets are always trying to estimate future outcomes. If investors believe the economic damage will be temporary, markets often recover long before the headlines become positive. That's why watching the evening news doesn't always tell you where stocks are going next. Markets and headlines often live in completely different worlds. Section 4. Oil, the market's biggest warning signal. Whenever conflict spreads across the Middle East, one number suddenly becomes extremely important. The price of oil. Oil is involved in almost everything we use every day. It fuels cars, trucks, ships, and airplanes. It helps manufacture plastics, chemicals, and thousands of everyday products. When oil becomes more expensive, businesses usually face higher operating costs. Transport companies spend more on fuel. Airlines pay more to fly. Factories spend more producing goods. Eventually, many of those higher costs reach consumers. That's one reason inflation can rise. Now imagine what could happen if shipping through the Strait of Hormuz were seriously disrupted. Oil supplies could tighten, prices could rise rapidly, and the effects would spread far beyond the Middle East. But here's something many people don't realize. The stock market doesn't simply react to higher oil prices. It reacts to how long investors think those higher prices will last. If traders believe the disruption will be temporary, markets often remain relatively calm. If they believe the disruption could continue for months, the reaction becomes much stronger. That's why investors watch every statement from governments, every diplomatic meeting, and every military development. They're not just watching today's price of oil. They're trying to predict tomorrow's. Because oil isn't simply another commodity. It's one of the world's most important economic signals. Section 5. The hidden power of central banks. Now let's introduce another player that often has even more influence over the stock market than war itself. Central banks. Most people rarely think about them, but professional investors watch every word they say. Why? Because central banks control one of the most powerful forces in financial markets. Interest rates. When interest rates are low, borrowing becomes cheaper. Businesses can invest more easily. Consumers spend more. Money flows more freely through the economy. That often supports higher stock prices. But when inflation becomes too high, central banks usually raise interest rates. Their goal is to slow spending and bring inflation back under control. Higher interest rates make borrowing more expensive. Companies often invest less. Consumers reduce spending. Economic growth can slow. That usually creates pressure on financial markets. Now think about the current situation. If a major conflict pushed oil prices much higher, inflation could remain stubbornly high. That might make it harder for central banks to reduce interest rates. And investors know this. That's why many professionals pay just as much attention to central bank meetings as they do to geopolitical events. Sometimes a single speech from a central bank governor can move markets more than an entire week of alarming headlines. Because investors understand one important truth. Wars create uncertainty, but interest rates affect almost every company in the economy. Section 6. Why bad news can actually push stocks higher. This may be the strangest lesson in the entire video. Sometimes, bad news makes stock markets go up. At first, that sounds impossible. But here's how it works. Imagine a new economic report shows that hiring is slowing. Normally, people would think that's terrible news. And for workers looking for jobs, it often is. But investors may see something different. A slower economy could reduce inflation. If inflation falls, central banks may have more room to lower interest rates. And lower interest rates often support businesses and financial markets. So investors begin buying stocks. The same thing can happen with weaker economic growth, or lower consumer spending, or disappointing manufacturing data. News that appears negative for today's economy may actually increase optimism about future monetary policy. That's why markets sometimes rise on days when the headlines seem awful. It's one of the biggest reasons ordinary people become confused. They see bad news. Markets see changing probabilities. Neither side is necessarily wrong. They're simply looking at different time horizons. The average person worries about this month. Professional investors are already thinking about next year. And that's one of the biggest differences between following the news and understanding how financial markets actually work. Section 7, AI is carrying the market. So if wars, inflation, and uncertainty are creating so many problems, who's actually pushing the market higher? The answer may surprise you. It's not every company. In fact, many businesses have struggled over the past few years. Instead, a relatively small group of technology companies has been responsible for a large share of the market's gains. Companies investing heavily in artificial intelligence have captured enormous attention from investors. Every few weeks, headlines announce new AI breakthroughs. Businesses are racing to adopt the technology. Governments are investing billions. Companies believe AI could improve productivity, reduce costs, and create entirely new industries. Because of those expectations, investors have poured enormous amounts of money into some of the world's biggest technology companies. As these companies grow, they have a much larger influence on major stock indexes. That means even if hundreds of smaller companies are struggling, a handful of giant companies can still pull the entire market higher. This creates something many people don't notice. The stock market may look incredibly strong, but underneath the surface, not every company is sharing that success. It's another reminder that headlines like "the market hit a new record" don't always tell the full story. Section 8. What happens if the Strait of Hormuz actually closes? Now let's consider the question everyone is asking. What would happen if the Strait of Hormuz were actually closed? No one knows for certain. And that's important to remember. Financial markets deal in probabilities, not certainty. If the disruption lasted only a few days, markets would probably react with fear. Oil prices could jump. Energy companies might benefit. Airlines and transport businesses could come under pressure. Investors would likely become more cautious. But if shipping resumed quickly, markets might recover just as fast. Now imagine the disruption lasted several weeks. Oil prices could remain elevated. Inflation could rise again. Central banks might delay lowering interest rates. Businesses would face higher operating costs. Consumers would spend more on fuel and less on other goods. That would increase pressure across the economy. Now consider the most serious scenario: a prolonged closure lasting months. Global energy supplies could tighten significantly. International trade would become more expensive. Economic growth could slow. Some countries could face fuel shortages. Corporate profits could come under pressure. Markets would almost certainly become far more volatile. Notice something important. None of these outcomes are guaranteed. They're possible scenarios. And that's exactly how professional investors think. They don't ask what will happen. They ask what is most likely to happen. Then they adjust their investments accordingly. Section 9. Why the wealthiest investors stay calm. Whenever fear dominates the headlines, experienced investors often behave very differently from everyone else. They don't ignore risk, but they also don't panic. Why? Because they understand something history has demonstrated many times. Every crisis feels permanent while you're living through it. Think back to previous global crises. The financial crisis of 2008. The COVID-19 pandemic. Major wars. Oil shocks. Periods of high inflation. During each event, many people believed the financial system might never recover. But over time, economies adapted. Businesses adjusted. Innovation continued. Markets eventually found their footing again. That doesn't mean every investment succeeds. Some companies fail. Some industries decline. Some investors lose money. But history shows that disciplined, long-term investors have generally been rewarded for staying invested, rather than reacting emotionally to every crisis. The wealthiest investors understand that uncertainty is part of investing. They don't expect perfect conditions, because perfect conditions rarely exist. Instead, they focus on managing risk, staying diversified and thinking years ahead rather than days ahead. That's one of the biggest differences between investing and gambling. Gamblers chase certainty. Investors manage uncertainty. Section 10, the biggest lesson history keeps teaching. If history teaches us anything, it's this. The world has always faced serious challenges. Wars, financial crises, political instability, pandemics, oil shortages, inflation. Every generation believes its problems are unlike anything seen before. And in many ways, every crisis is unique. But one thing rarely changes. Human beings continue building. Companies continue innovating. Technology continues advancing. Businesses continue finding new ways to grow. Markets don't rise because the world is perfect. They rise because people continue solving problems. Every decade brings new challenges. Every decade also brings new opportunities. That's why the greatest mistake isn't believing that bad news exists. It's believing that bad news automatically means the future cannot improve. Markets don't reward fear. They reward progress. And progress often happens quietly, long before the headlines begin reporting it. So, if the world seems to be falling apart, why are stocks still near record highs? Because the stock market isn't voting on today's headlines. It's constantly placing bets on tomorrow's possibilities. Yes, wars create uncertainty. Yes, rising tensions in the Middle East and concerns about the Strait of Hormuz deserve serious attention. Yes, higher oil prices, inflation, and geopolitical risks can affect every economy on Earth. But investors know something many people forget. Today's crisis will not last forever. Eventually, conflicts end. Supply chains adjust. Businesses adapt. Technology moves forward. New opportunities appear. That doesn't mean markets are always right. Sometimes investors become too optimistic. Sometimes markets become overvalued. Corrections and crashes are a normal part of investing. But history has shown again and again that fear alone has rarely been enough to stop long-term progress. The biggest financial mistake isn't paying attention to the news. It's believing the news tells the entire story. The market and the headlines often seem to disagree because they're answering different questions. The news asks, "What happened today?" The market asks, "Where will the world be years from now?" And perhaps that's the most valuable lesson every investor can learn. The future is never certain, but history suggests that those who stay informed, remain patient, and think long-term are often in the best position when the next chapter begins.